Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Past week has seen a dramatic rally in Chinese and Hong Kong shares, sparked by a long-awaited range of stimulus measures unveiled by Beijing at the end of September. Today on the show, Julian Hofmann and Dave Baxter will discuss the impact on UK-listed China-focused investment trusts, as well as on some of the many UK shares that have exposure to Chinese markets. Our cover story this week, meanwhile, is on investing for your children or grandchildren, how to do it, what to invest in, and perhaps most importantly of all, how to engage your offspring on the subject of money. Val Cipriani is here to talk us through the issues. Before all that, though, we are looking at real estate investment trusts. Like many trusts, Reits are still typically trading at big discounts to net asset value. Natasha, our property reporter, has been looking at a couple of specific areas in recent days. We're going to start with Science Reit, which, as its name suggests, focuses on properties leased to tenants in the life sciences sector. That means a lot of activity in the UK's so-called Golden Triangle between Oxford, Cambridge and London. But sentiment has been pretty mixed in recent years, Natasha, more or less ever since the REIT's IPO in 2021, in fact. It reported interim results the other day. What did they tell us?
Yeah, so it's one of the REITs that was set up kind of in the middle of COVID. It IPO'd, as you said, in 2021, which was really during a pretty booming time for life sciences. And at that time, VC investment was rising, particularly during COVID. So it was quite an optimistic time. But then since then, it's been quite slow to lease up, although there are signs that that's getting better. So they now have 3.2 million of estimated rental value under offer or in advanced negotiations, which is pretty good, but it's just that investors kind of expected it to come a bit earlier. But then it's still, like a lot of real estate companies, reported a loss, which was down at 13 million, primarily driven by valuation write-downs of 15.4 million. And then that, as we saw earlier this year, then drove the decision to rebase the dividend from 4p to 2p.
Yeah, you're right. Actually, despite me saying it's been mixed since the start, right at the start of their life, things were still okay. 2021, it was kind of a year later, wasn't it, with interest rates starting to rise?
Yeah.
Things went awry somewhat. What about how things progressed over the period? Because they made some noises about differing levels of activity over the quarters. I know you spoke to the chief executive as well. What did they say in the results? What did the chief exec say about how he sees the lay of the land at the moment?
So like a lot of people in the real estate space at the moment, he sees it as being a bit of an inflection point as valuations perhaps start to improve with interest rates coming down. And I think also he was sort of talking a lot about renewing with existing tenants and signing on more leases, which will improve the company going forwards. He also said that there's been significantly higher inquiry rates, which points to an uptick in activity, perhaps for the next half of the year.
Yeah, he made probably if we had a pound for every time someone said this, we'd be very rich ourselves. You know, he made the suggestion that the bottom is now in for the market.
So we've been calling that for several years. But...
Yeah, we'll see what happens there. In terms of the leasing activity, though, they did also make positive noises about VC funding. Because, of course, the life sciences sector requires that funding if they're going to get things going, and therefore if they're going to lease more properties from Life Science Reit. So there was some positive noises on the funding side of things as well.
Yeah, there were some positive noises. When Life Science Reit was IPO'd, it was sort of at one of the high points in VC funding, particularly during COVID, with lots of investment in vaccines, biotech, etc. But the problem it's had is that since then, VC funding has declined. So the KPMG latest report said that VC investment have fallen to the levels last seen in 2018. And this obviously has a knock-on effect in terms of demand for lab space, because if the occupiers aren't able to get funding to scale up, then they don't need either A, lab space, or B, to increase their space. So that's really sort of dented sentiment, particularly in the life sciences space over recent years.
Yeah, they're also talking about another big plank of the life sciences investment case about government funding and the potential for the government to provide support. I mean, maybe we'll hear some more about that in the budget.
Yeah.
Again, though, that kind of thing tends to be a structural, you would hope, pillar rather than something that's going to drive change immediately in the short term, you would assume. What about the prospects for the REITs maybe over the medium term? Because it is still a pretty small company market cap wise, just over 100 million. The board says it's evaluating all the options given the discount, which is still at over 50%, I think. Dave, maybe bring you in because you did. Life Science Reit did come up in a separate piece you wrote this week.
Yeah, so analysts at Winterflood have identified trusts that they view as being potentially subscale. So it's kind of below a certain market cap, so below 300 million this time. This is an update from a previous analysis, but it's also names that have sort of languished on a wide discount that have had a bout of kind of underperformance. So you did see this trust pop up, and to be fair, some other kind of names in the property space reflecting those kind of issues that you mentioned before.
Which wouldn't necessarily be bad news for these trusts if they are taken over. The question is who might take it over, Natasha? I mean, there aren't really any comparable REITs in the space.
No, Life Science REIT's the only UK listed sort of pure life science REIT. There are a couple of names in the US, but the US markets have their own problems at the moment, particularly with an excess of supply in Boston. So that seems pretty unlikely. The only other two names that spring to mind are perhaps British Land or Landsec, who've both gone into the space recently. But then it's still difficult to see them sort of going and buying the entire portfolio. So what's perhaps more likely, if there were to be a takeover, is a takeover by private equity, who we've seen coming back into the REIT space in recent times. So Starwood announced their offer for BCPT, which is the first private equity kind of bid or serious bid since Blackstone's take private of Industrials REIT back in 2022.
Yeah, indeed. Let's move on because another vaguely related part of the REIT sector you've covered in recent weeks has been the healthcare REITs, the two REITs which are quite closely related in terms of what they do, what they look at. That's Assura and Primary Health Properties. There has been a bit of divergence in performance between the two recently. Well, what can we say about these portfolios? What do we look at in terms of things like their revenue split? Because it seems to be a particular interest to analysts at the moment is the way the amount of government-backed revenue that these REITs have, the way that's starting to change a little bit with a deal Assura has recently done. Because clearly these revenues give you a good support stream and a solid earnings base, but there are other ways they can make money too, and Assura has started to head a bit more down that route, perhaps.
Yeah, what's quite interesting about the two REITs is that they started from a pretty similar space. So both started primarily with GP surgeries, which is government-backed income. But then Assura started to move perhaps more into the private space. So they already had a bit of exposure to the private healthcare sector before they bought the 400 million portfolio from Northwest, which is a Canadian trust. And this kind of increases their exposure to the private healthcare sector, which they see as being quite a good investment, particularly in the short to medium term, as more and more people turn to private healthcare in the face of long NHS waiting lists, and also just an increase in use of private healthcare generally. Whereas PHP sees their strategy going forwards as being very much in the public space, primarily led by GP surgeries. But then they also were talking about going into step-down facilities, which is kind of a bridge between hospital and going home. So, I mean, I kind of think of it as a bit like a World War I convalescence home. You go there when you're not quite ready to go home, but nor do you want to be in hospital. And that was one of the things the Darcy report also highlighted, is the need to care for people outside of hospitals where possible. So that's how they're reacting to the changing market.
Yeah, sort of like the sanatoriums you get in Central Europe, that kind of thing.
Yeah, I mean, I sort of think Downton Abbey's situation,
Yeah.
but I'm told they're going to be very modern.
Right, I see, yeah.
Fewer stately homes, more kind of lino floors.
Yeah. It seems unlikely there'll be stately home-esque, doesn't it? As a final point on this subject, really, though, the developments they do have in the pipeline, some of that work is on hold at the moment. They are looking for higher rents, effectively, it seems, or at least they're looking for a bit more in the way of the negotiations they're having at the moment, which is sometimes a tough argument to make when you're talking about healthcare facilities, but there clearly is a bit of a mismatch. Both trusts seem to think at the moment in terms of what's on offer.
Yeah, I mean, the problem is that, like for a lot of people in the property space, construction costs have increased a lot since those deals were agreed, since planning was put in. And that just means that they're not viable anymore at the rents previously agreed. But then the problem, as I've been told, is that the rents are based off comps. And so if the last available comps are before construction costs went up, that means that they're below what the market needs them to be now in order to make those developments viable. So both of these REITs have developments on hold. I mean, Assura has been pretty public about the ones they've got on hold, and they're sort of waiting for a new rent agreement.
Yeah, so we'll see what happens there. I mean, clearly there's a lot of reform in all parts of the healthcare space at the moment going on or being mooted, so potential for some changes there as well. Let's turn now, though, to our cover feature this week, which is on investing for children. Val, you wrote the piece. Why don't we start with an overview of the, very broadly, of the wrappers, the structures available, because there are three main ways to do it if you put aside the whole question of what you tell your children and how much you want to save and how you invest it, some of which we'll come on to in a moment. But there are the three main choices, really, some more complicated than others. But why don't we just give a quick overview of those to start with?
Yeah, sure thing. So it's three main accounts, as you say, a junior ISA, a junior SIP or pension, or what is called a bare trust account. So in the future, we have all the details about how each of them works. But basically, in a nutshell, when it comes to choosing which one you want, it's about finding a balance between how tax efficient you want it to be and the degree of access to the money you need or when you need it mostly. So junior ISA is obviously a very popular option. It's very tax efficient. So obviously, you get tax-free growth on everything you put in, and then you take it out again tax-free, and the money becomes available from when the child turns 18. So it tends to be good for things like university costs, deposit for a first home, that sort of things that a young adult may need. Then you've got the junior SIP, which is also very tax efficient. It works basically like an adult's pension. So you pay something in, you get tax relief on contributions, usually a relatively small amount because obviously children don't actually earn any income. So the limit is £2,880 of net contributions paid in on which you can get tax relief. But obviously the big downside is that the money cannot be accessed until the child reaches the pension age. So we're talking about what is currently 55 but is increasing to 57, and who knows, of course, how much more it will increase. On the plus side, it does mean the money has a very long time to grow. You put in relatively little money, and by the time it becomes available, you have a lot because it's been so long. But yeah, it's a very long-term way of saving. And then the final, perhaps slightly more niche option is that you can set up a trust for your children. Now, normally trusts are quite specialist vehicles and you need to take legal advice often. But there is a sort of basic version of this that is called a bare trust account, which some platforms just do offer directly. So basically, you can think of it as a general investment account for children, which means that everything is subject to capital gains tax and income and dividend tax, depending on how you invest. There are still some tax advantages depending on how the money is funded, which we do explain in detail in the piece because they're slightly complicated. But basically, long story short, you get access to the money. It just needs to be used for the benefit of your children. So, for example, an expensive school trip, private school fees, that sort of thing. But yeah, the tax advantages are less than the other two accounts. So yeah, basically, depending what the money is for, but generally junior ISAs most popular, and that's where you start from usually. And then if you have extra money, you pick one of the other two, depending on when you want the money to become accessible.
As we alluded to, the question of accessing the accounts is perhaps the knottiest part of this whole subject, and potentially one that causes the most angst. It's a nice problem to have, but angst among parents, perhaps, because the very fact that they will have been investing, say, with a junior ISA for, say, 18 years if you start at birth, means however much you put in, you're probably going to have a pretty big pile of money there at the end, and suddenly that money all goes to the child, and that's when parents think, oh, we've given our child a vast amount of money. We have no choice but to give them this money. Again, a nice problem to have, but also they might think, well, do we want them to have all this straight away? Will they be responsible with it? That kind of thing. So the other piece of this is education as well, and talking to your children about the investments before the money goes to them. I imagine, and Greg Davies, the behavioral finance bod, as I'm going to call him, had some good comments to make on this subject. I think quite interesting comments about his own experiences trying to teach his children, prepare them for managing their money.
Yeah, it was definitely an interesting conversation I had with him, and in generally quite an interesting subject because it so depends on the people you're talking about. Because at the end of the day, when they turn 18, they're like grown-ups, and it could be you could go any number of ways, from just kind of like really responsible young people to just kind of like maybe they will not use the money wisely. And obviously, if you start investing at birth, you have just no idea of how their personality is going to be like. So it's quite a tricky call in a sense to make. But Davies was rightly making the point that you can obviously like kind of train them to become people who know a bit about money and are potentially good at managing it. And so some things he was saying were that, for example, it's quite surprising how often actually children and teenagers hear about like investing related topics at school or, among their peers and stuff. And it's usually, what he called like the wrong type of investing. So things like, crypto, meme stocks, that kind of thing. So the challenge is sort of turning that into like a more right kind of interest. So teaching things like, the value of being patient, letting your money grow over the long term, and how compound interest works, that sort of thing. And so his sort of case was for having a lot of like small conversations, like rather than one big one close to, the age of 18, but rather quite a few like smaller ones, starting when they're like maybe even 10, 11, 12, whatever, and sort of like teaching them in short bits. So then when they get to that point of having access to what can potentially be quite a big amount of money, they have an idea of how everything works and hopefully will use it wisely.
One thing he discusses is the use of pocket money apps. So you could start even earlier than a double-figure age child, which I believe is a very popular term. No one's ever said that phrase before. But those apps are quite interesting in the way he sets an artificial interest rate for them for their spare money.
Yeah, it's quite an interesting thing. So basically, pocket money apps, they're kind of like, usually you get a debit card for your children and you can start like when they're like, I think as soon as like 6 or something. And you just put a bit of pocket money in there and they can use it to do whatever they want, buy chocolate or whatever. And then you have like quite strict parental controls, so you can see how the children are spending the money and put some limits and all this kind of thing. And so one feature that some of these apps have, which is what you were referring to, is that basically this pocket money, the children can choose to save some of it and put it on the side in a sort of artificial savings account. And then the parent sets the interest rate for this account. And so what he was saying is that he sets quite a big one, because obviously it's a small amount of money, so he doesn't really need to worry about it that much. I think he says he set an interest rate of like 20%. And the reason he does that is that so this way his children can see that the money grows a tiny bit every month. And so they understand the value of not spending it and saving it instead, and just see it grow. Which at the end of the day is the same principle as investing, obviously. So
yeah, it really makes the compound interest more visible.
Yeah, exactly.
With a 20% interest rate.
I would like a 20% interest rate on my account. That would be nice.
We were going to talk about kind of funds you can invest in, but maybe we should skip over that because we have a limited amount of time and we do have a few options in the piece, and we can also point people towards our top 50 ETFs, top 50 funds features, which we've covered recently. But one thing I wanted to cover before we wrap up this segment is just on time horizons, or the amount of time involved, because clearly you're investing for the long term when you're investing for your child, assuming you do it at an early age. So therefore, quite a pro-risk portfolio makes sense, equity-heavy portfolio. But there are things to watch for if you're considering things like junior ISAs and considering the fact that the money might need to be used even in, say, 5 years' time. That does therefore necessitate maybe a bit of a change of an approach in terms of the asset allocation.
Yeah, absolutely. I think you need to start, because by definition, children's investments, they're very long term until they're not, because the children grow. And I think the thing with the junior ISA is that as we said, you don't have full control on what your children are going to do with it. So, when they're teenager, you really, really need to start thinking about whether they might need or decide to use the money quite soon after they turn 18. And this could be for things even just like university costs, at which point you do need to sort of de-risk the portfolio, so potentially dial down on equities and put a bit of bonds or other assets in there. As we know, when the time horizon gets shorter, then you don't want the same level of volatility, because then otherwise you risk having to take the money out at a bad time for the markets and just like losing a lot of the growth you potentially accumulated in previous years.
Yeah. Well, that is our cover feature, as I say. That's available online in print. Do have a look if this has whetted your appetite. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. To conclude today, though, we are going to be talking about China, the big stimulus measures it's introduced, and the subsequent market reaction, the pretty intense market reaction, up 25% or so in little over a week, which is even more impressive than a 20% monthly interest rate in some ways. Julian, why don't we start by just outlining maybe the context and also some of the things that the authorities have done to what this stimulus actually involves.
The context of this is that for several years now, China has stubbornly refused to add a stimulus to its economy, despite the relative failure of coming out of lockdown to produce new growth. That has changed relatively radically in the last quarter, mainly because the Q3 figures, when you start to dig into them, were looking very weak indeed. So it sort of got to the point where the government had to do something to boost confidence, as it were, or look at possibly ending the year with a descent into deflation and recession at the same time. So that is the ultimate nightmare scenario for the Chinese government. And this stimulus package, although it's relatively contested, has the effect at least of boosting investors' confidence in China shares themselves, and this is why the market has reacted so positively. And as you alluded to, the jump has been big enough that it's actually shifted kind of the general emerging market indices by a significant amount, which tells you that Chinese shares have had to jump a lot in order to get things like the MSCI Emerging Markets Index to move. So it's a kind of throw of the dice, I think is the best way to describe it, from the Chinese government. The investors, in a sense, are the short-term beneficiaries, but I don't think anyone should be under any illusions that what's prompted this is actually some pretty dire Q3 numbers in manufacturing.
Yeah, that's perhaps the difference this time, as opposed to previous stimuli over the past, say, 15 years. It's certainly been the case that this has been awaited for a long time, and there have been some piecemeal measures which haven't really moved the dial. But this week we've seen changes to reserve ratios for banks, a big cut there. There were additional liquidity measures, loan funds to fund share buybacks, which sounds like a good plan, maybe slightly risky.
Yes. You can now pledge shares to the central bank in order to get government bonds, which is a novel way of getting liquidity into the market. Although the market is welcome, it's actually a very contested stimulus as well. If you're saying that liquidity is the problem, China's definition of broad money with the M2 money supply is double what it is in America at the moment, obviously, because the Fed has been raising interest rates and cutting down on the money supply. But there is plenty of money in China's system, and this is really, it's difficult to know how adding more liquidity is going to make much of a difference beyond the stock market. Whether that actually filters into a broader economic recovery.
That's the question, I suppose, which we'll get to. Sometimes this momentum can be powerful, and it's clearly very powerful at the moment, albeit it's early days. Dave, what about the investment trusts? Because there are a few UK-listed China-focused trusts that we cover. They clearly have done pretty well over the past few days. Which trusts are they? how can we differentiate between them, and are there any kind of related winners or potential other winners in the funds and trust space as well?
Yeah, so you've got three dedicated China trusts. One is JP Morgan China Growth and Income, one is a Bailey Gifford Trust, and one is Fidelity China Special Situations. They're all over, say, a week and a half. They're all up by roughly, similar amounts, 30-ish% or so. Of those three, although to be fair, it is lagging the other two very slightly over that period. One name we've tended to like as a sort of play on a Chinese recovery, particularly back when we were talking about that idea of a Chinese reopening trade at the start of last year, was the Fidelity Fund. That's because it focuses quite heavily on kind of the Chinese consumer and the idea of Chinese consumer recovering. And also it's just much more gung-ho, I suppose, particularly in that it has a very hefty level of gearing. Recently had 19% gearing versus 4% for the JP Morgan Trust and 3% for the Bailey Gifford Trust. So that's potentially a much racier option, but if we do see a sustained recovery, then in theory, that should be the sort of name that would kind of make more hay. And then turning to some of those kind of broader names, I suppose what's been notable, if we look at this context of, say, 30% or so gains for the China market, one global equity fund with a big focus on China in recent years and even now is Scottish Mortgage. But actually those shares are only up by 3-4% or so. So you're not quite seeing the correlation you might expect with some of their big bets on Chinese kind of internet stocks and so on.
I think that's probably more reflective, isn't it, of their US exposure. The big US companies, they still hold, clearly having more of a sway in the US market. It's still, it's not doing anywhere near as well in the very short period of time that we're talking about. So perhaps that's why there. Julian, what about the share impact, if there is much of a share impact? Because stocks like Burberry, I was looking at, you might think there'd be quite a big uplift, even in hope rather than expectation of a Chinese consumer revival or some more interest in luxury goods. But there hasn't really been much to speak of, which perhaps speaks to skepticism over what you were alluding to earlier about whether these stimulus measures will have an effect on the economy. What have you seen on a share-by-share basis?
Well, I mean, it's interesting as well that people like Ashmore, which are emerging market focused investors or investment funds, they've barely moved at all compared with some of the trusts. And obviously that, I think that reflects the fact that they're more into things like debt instruments, and that in a way is more correlated to the state of the Chinese economy. And as you say, the luxury brands, and we're not just talking about UK brands, but in Europe as well, Richemont, that kind of industry, they've not moved at all either. And I think it reflects perhaps a more sober view of investors on this side when they look at China. And when you see the underlying figures, which these days is actually quite hard to interpret because the government has been restricting all sorts of statistics. Consumer spending and key variables like manufacturing orders and consumer price index in China is actually contracting. The stock market is voting, as in a sense, the Chinese stock market is voting on the stimulus. It isn't actually reflecting its impact. Whereas paradoxically, foreign shares are looking at this, and foreign investors are looking at this and actually taking perhaps a more sober and skeptical view about what the Chinese government can actually achieve with this stimulus. There is some suggestion that really it's about stopping the selling pressure that had been affecting the Chinese market for a long time. And the aim is not so much feeding it through to the economy, but actually just giving people enough confidence to stop dumping shares. And that's a very different thing from a full economic fiscal stimulus, which is why other shares that might be reliant on the Chinese economy have not reacted to that already.
Yeah, that split does seem quite important, doesn't it, between domestic investors who are clearly enthused and being incentivized to be enthused by these stimulus measures, compared with foreign investors who, after all, have had reason to stay away from Chinese markets for a while now, not just economic reasons, but also in terms of some of the regulatory crackdowns we've seen. The lack of reaction in some of those shares we spoke about does suggest that that the foreign investors aren't quite getting involved in the euphoria yet. But who knows if it
No, I
lasts?
mean they don't even publish cross-border fund flows anymore. So you can't even tell which foreign investors might be buying into this rally, might be selling out, because they've banned the statistics on it. So the only measurable way is perhaps to look at Burberry's share price and see what the investors in Burberry think. I mean, that it's kind of got to that situation.
Yeah.
But I mean, people have kind of bought into it, at least on a domestic level, because there are signs that the government is being a bit more pragmatic than it has been in the last couple of years. They've appointed a kind of a technocrat to oversee the reforms, oversee the stimulus package. He's quite well respected, Mr. Wu King, and it's it comes down to how people perceive him as a personality, and whether his background as a kind of pragmatist will actually help help the economy, or help the market at least to have more confidence in itself, and that seems to be at least the first priority for the government. Indeed.
Well, we shall see. I dare say if the rally continues for many more weeks, we might see some overseas investors getting involved as well, but the jury is still out on that for now. That does bring us to the end of today's show, though we have concluded. We have run out of time, alas, once again. Thank you very much to all our contributors. Thank you to Julian, to Val, to Natasha, to Dave, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.